Okay, it looks like we are live. So welcome to everyone who is joining in on this session. Give a few minutes or give a few seconds for everyone to sort of settle a little bit. This is going to be our real estate credit conversation. So everyone should be looking for that event. And let's go ahead and get started. My name is Kyle Campbell. I'm a senior reporter with PERE, which is a sister publication to PDI. I specialize in coverage of the private real estate investment market with a particular focus on institutional investors in North America. Peter, would you mind giving a brief introduction of yourself before we get things started here?
Thanks, Kyle. Peter Plaut. I represent the Wimmer family office based in London. We are focused on providing capital to the metals and mining, alternative energy space, and in particular real estate. We focus on basically credit facilities anywhere from 150 million to a couple billion. We're predominantly debt providers, but we could also take equity as well. Great,
great. Now, just to give everyone at home or wherever they're watching from a little heads up, we're going to have a 50-minute conversation here, about 45 minutes or so between Peter and myself. We're going to touch on a wide range of things, ranging from the sort of broad, big picture issue of COVID-19 and how it's impacting investment, and then we'll kind of get into granular details about specific types of investments, structuring, underwriting, and any number of topics of the day that will be relevant to hopefully everyone in attendance. And then we're going to reserve about 5 to 10 minutes at the end for audience questions. And so feel free to stockpile those up and then send them along towards the end, and I'll let you know when we're going to start taking those. So let's start with the sort of the title or the topic of today's talk, which is short-term challenges and long-term opportunities in real estate credit. Now, of course, those two have been a big theme of COVID-19, as they are in sort of every crisis period. So Peter, I'm curious, how are you balancing those two components, the short-term distress and the long-term opportunities that are arising on an investment front for you?
Great question, Kyle. So I think it's important to start with COVID-19, and it's really created economic and financial issues far exceeding the problems of the GFC in 2008-9. I would say the best comparison, Kyle, is the Great Depression when I look at aggregate declines in all components of aggregate demand. I wrote a white paper on this that was broadly published on the GRI Club's website and the MIPIM website back in March 2020. It was discussing these issues and was titled The Super Economic and Social Depression of 2020. The near-term challenges are not just economic and financial, but they're largely social, and the pandemic has taken a huge toll on humanity. In terms of industries that have been affected, people talk a lot about retail and hospitality, and indeed, hospitality represents upwards of 15% of GDP for countries such as Italy and Spain, but entire industries have been just decimated, not least of which small and mid-sized businesses, Kyle, without the same access to liquidity and capital markets as the larger companies that have been benefiting from the large influence of liquidity coming in from the Fed and other central banks. On the other hand, technology and health-related industries have benefited quite significantly. As a family office and based in London, we have the ability to take a longer-term view. Indeed, while I would say our debt facilities are about 5 years in duration, our equity can be multi-generational. So in the near term, we're looking for opportunities in those sectors that have been beaten up by COVID, but otherwise have great management teams and can benefit from a large amount of capital. We recently signed an engagement with a large US developer for over $2 billion. And the 4 strategies that we looked at there were core and core plus, value add at discounted pricing, joint ventures and consolidation, opportunistic distress, and even hospitality.
Got it. Got it. You talked about towards the end there something that kind of feeds into this next question that I had, which is how is this period of disruption changing the way you assess and define investments on the spectrum between core and opportunistic? What are some of the changes that have taken place because of this situation, and how are you approaching it?
Well, that's another great question, Kyle, and it's highly relevant. Core has several definitions depending on the investor's reference frame, right? So for me, it's best defined as lower yields for lower risk, and this has been typically the case for assets in large metropolitan cities. It has always been more of a focus for pension insurance money and asset managers, I would say, willing to accept lower yields for lower risk. Never has it been a big focus for us at Wimmer because we look to try to take higher risk for higher returns. But the current environment has definitely presented opportunities to buy core and core plus at discount prices, and this trend will likely continue throughout 2021. Opportunistic doesn't necessarily mean distress, so you need to look at it on a case-by-case basis, but there will likely be significant distressed opportunities as the economic crisis continues to unfold. That could be, Kyle, forced liquidations, short-term liquidity needs via capital injections, structured financing solutions, and joint venture opportunities.
Gotcha. Just a quick follow-up on that. You mentioned a few different structures. Are there any of those that you're seeing more or less of or you have in the past few months, or are you kind of taking an equal opportunity approach to those various structures?
Well, it's interesting, and I think it's very, very important to look at basically what happened right after the COVID lockdown occurred in late March, early April. We saw just a tremendous amount of opportunities as companies needed liquidity, and they drew down on credit facilities quite dramatically because they were concerned that the banks would stop lending, capital wouldn't be available. So it was very similar to a repeat of what we saw during the GFC. However, then the central banks came in unprecedented measures and provided so much liquidity that we really had a short-term time frame to get involved in a lot of securities and stuff that you might otherwise have thought of would take a year and a half. It was pretty much compressed to about 3 months. Now, I think we'll have a second lockdown. I'm sitting here in the UK. Prime Minister already announced we're about to go down to a second lockdown. Could be as long as 6 months. That'd be devastating for industries, banks, etc. So I think there'll be another opportunity for us to find opportunities across the real estate space over the next, call it, 6 months or longer.
That will be quite the disruption if it were to lock down again.
It's not when.
Yeah,
I mean, it's not if. It's
when. Right. When that happens. Well, we talk about themes of this period, and one theme that seems to be sort of reoccurring in a lot of conversations is acceleration, particularly of ongoing trends, be it the rise of logistics or the demise of retail. Which of these accelerated trends do you see having the biggest impact on your approach to real estate investment?
Look, retail's been facing long-term structural declines over the past 20 years due to technology, such as online shopping. Everybody's well aware of that. COVID-19 has simply accelerated this trend. However, there's definitely an opportunity, the way I look at it, for repositioning of retail assets to multi-residential type of assets, what we call in the UK BTR and PRS schemes. There's also an opportunity to provide liquidity to retailers, such as 25-year triple net leases to provide them with liquidity. On the hospitality space, similar to retail, the opportunity to reposition hotels for residential, office, and others. So we're looking at it for finding developers that have the ability to reposition several of these assets that are unlikely to come back in any time soon.
Right. So you mentioned triple net lease opportunities as being a sort of favorable structure for right now. Is this something that you think groups are a little bit more willing to engage with as a sort of a way to kind of generate some short-term liquidity, like a solid operating company that maybe doesn't need to own its own real estate, taking that opportunity on more readily because of this current environment?
Listen, I think there's a great opportunity in providing liquidity via triple net leases. We saw that in the GFC. We saw that in the UK here post-Brexit. tremendous amount of shopping, high street retailers that own their underlying retail real estate, needing liquidity, short-term liquidity, and a lot of the larger credit funds were able to step in quite quickly and buying that real estate at a discounted price and then unlease it to the high street retailers. However, the problem is, since the GFC, is the demise of the high street retailers continue to take place. These structural challenges just accelerated over recent years, and then obviously COVID has hit it more. So I think now is an opportunity to provide that liquidity through triple net leases. But I think what happens is the high street retailers will consolidate, be smaller, and the actual real estate underlyingly can be repositioned for, as I mentioned, residential in various forms, and other types of real estate assets.
Sure. And you see that kind of both U.S. And Europe, those sort of opportunities?
Absolutely. And it's already, you don't have to take my word for it, anecdotally, it's already taking place across the U.S. and across Europe. And I'm very involved in that space.
Oh, great. We'll get into that a little bit more a bit later. So I'm curious right now to understand how things have changed in terms of your approach to underwriting as a result of the pandemic. Let's maybe talk about sort of how you're underwriting specifically for this scenario and how you're sort of maybe adapting your underwriting processes moving forward.
Listen, as a family office, we're going to be much slower in general than a private equity or credit fund in the way we approach things. We're looking at preserving multi-generational wealth. So we're looking to protect the balance sheet of the 5 families that we represent over the generations. So what's most important is the pandemic has basically focused us to take a much harder look at the opportunities that present themselves to us. So the underwriting process is taking longer. The deeper dive due diligence is taking longer. The checks and balances of, you have an initial developer coming to us showing us a great potential asset. The ability to walk the land, the surveys, updating valuations, that's all obviously with a lockdown is much more difficult. The law firms are taking that much more time. Covenants that have been kind of thrown to the wind in recent years by banks and others have, covenant light loans have, come back to style. And now all of a sudden, putting strict covenants in place again is something to consider. However, you also have to look at those covenant breaches, given the fact that if we're looking at an office tenant that can't pay their lease, then obviously they need to be modified, but you can't modify indefinitely. At some point, foreclosures will take place. So we're taking more time with the due diligence, the underwriting process. We're more diligent, we're more careful. For us, we're focused more on the quality and the track record of management and their ability to execute on their projected pipeline more than anything else. Got it.
Yeah. I definitely want to get into that. The manager portion of things, but first I'm curious if you've been able to use technology in any new ways to help with that underwriting process. Maybe drone footage or anything like that to sort of replace a physical walking of a property, or are there any other sort of technological things that you've taken to in this period, or are you still really focusing in on the tried and true methods for evaluating investment opportunities?
Well, actually, from our point of view, it's tried and true. I have developers sending me fantastic panoramic shots from drones and stuff like that, but that doesn't really help in the credit decision as much. I think what's more relevant to the discussion, and I've been on a lot of technology calls, funny enough, where I really have no background in that, but they're asking me to talk about Fintech. They're asking me about technology in the hospitality space. I think there's a huge opportunity. Your car, your Lexus, or other cars have more information about you when you sit in that car than office buildings and residential buildings. I think that's going to change, as well as with hotels in the near future. On the hotels, you're going to not check in with a handsome young man or pretty young girl in terms of the being welcomed. You'll check in from your mobile phone on the way from the airport or wherever you're located. When you order room service, there'll likely be an app to an outdoor vendor rather than something that's in-house. So technology is going to be key. I also think there's going to be an opportunity for the Googles and Apples of the world to work with smaller mid-sized technology companies to put screening type of cells into hotel rooms to monitor, and this could be not just a hotel, it could be a care home, monitor the person that's in there, not by cameras, but maybe their body temperature, et cetera, not for COVID, but also to see if there's somebody sick and need to call an ambulance or the fire department, et cetera. So I think we're going to see a lot more use of data and technology as it applies to the office environment, residential environment, and hospitality going forward. And I'm looking to invest in some of those as we speak.
Oh, interesting. Interesting. Well, getting back to the manager or the partner side of things, as we move into this economic downturn, how are you adjusting your criteria for evaluating those groups, and how are you changing maybe criteria for who you lend to? Are there certain things that you're looking for that are either different from the past, or maybe things that you've learned from previous downturns that you're really putting a greater focus on in the current environment?
Listen, I've been doing this for about 35 years now, and I've been investing throughout numbers of crises, from the Resolution Trust Corp back in the savings and loan crisis in the late 80s, early 90s, the Mexican TILA crisis in 95, the Asian crisis, 97, 98, followed shortly by the long-term capital, the Russian crisis, followed by the telecom bust, the internet bust, and then obviously the GFC. I've never seen a market like we're experiencing now. The pandemic, the human toll is massive. The devastation of industries that are not just related to housing, like we saw in the GFC, and tangential to that. The aggregate falls in every component of aggregate demand, both in the US and Western Europe and other parts of the developed and developing world, is not been witnessed since the Great Depression. So what I'm seeing and what we're doing, I think first of all, we're taking a much more hard look as management in the underwriting process to work with managers that have many years of a track record in terms of economic cycles, and giving us the confidence that they could execute throughout this dip in the business cycle, which is quite significant. Our interest rates have not changed that much in terms of the coupons we're offering, but there is clearly a spread that has probably gone up. But when you look at the overall lower yields, the overall cost to the borrower might not be that significant. Where we're really looking to be much harder is on the IRR demands. In the past, we might have sected mid to high single digit type of unlevered yields, the levered yields, and kind of the low to mid single digit, low to mid teens. Now we're looking at high teens, low 20s, even unlevered opportunities in real estate, which is unheard of. Obviously core and core plus, you're not going to get that, but even there, we're looking to be much more prudent on where we put our equity risk, and looking at it from a relative value perspective and globally around the world. It means you want to invest in just in a liquid real estate developer for the next 5 to 10 years, or is it better to buy loans in the secondary market or other securities? So we need to look at relative value from that point of view, and more liquid opportunities that surface. But again, I think over the next 6 to 18 months are going to be opportunities to purchase real estate at opportunistic pricing levels, and also helping in the trend towards joint ventures and consolidation that has not been witnessed for over a decade, going back to the GFC. So we're being very prudent on where we put our multi-generational capital, but at the same time, obviously looking to require more returns on the capital that we provide, specifically on the equity that we provide.
Absolutely, yeah. And as far as track record, I mean, I'm assuming that's something that's coming into a greater focus now than maybe it has in the past 10 years, when, especially the last 5 years or so, when it just seems like it's been sort of a steady rising tide, where a lot of maybe less proven groups were able to succeed. How much of a greater focus now then are you placing on track record for trying to decide who to partner with in these coming?
That's of ultimate importance. I mean, is corporate governance, the track record ability to execute throughout various economic cycles, developers having adequate liquidity for their working capital needs, including paying compensation, et cetera. So in recent years, we'd have a guy or two guys with a laptop computer, and say they're building 2-family homes, and now all of a sudden they want a 200 million credit facility from us. That's gone. And that also brings up another point. Banks are going to be retrenching further.
Mm-hmm.
It is just simply looking at it from an economic and historical point of view.
Mm-hmm.
If we look at banks during economic cycles, they retract from lending. That's already taken place. The other thing that we have to look at prior to the pandemic is the FASB instituted more stricter rules for reserving for non-performing loans. That has an immediate hit to EPS. The same thing with the IFRS. So we had a regulatory burden. Then we had the pandemic. So what I think you're going to see is banks are just not going to be there. Bank debt financing is going to be harder to come by. Loan to values, 55% won't be unheard of. The days of 80% and looking at lending based on profit on cost, those days are clearly over, at least for the foreseeable future. The alternative credit providers that are coming in have LPs that they're beholden to command a higher return on their investment. So the overall cost of capital for developers, whether large or small, are going to be at a price. There's no doubt about that. And there's going to need to be more equity in a transaction. I'd argue, Kyle, if you look at the hospitality space right now, it's very hard to look at what the potential cash flow is when most companies are operating at a 40% occupancy rate, which is luckily if it's break even. Therefore, I can't lend against that. So more equity is going to have to be put into transactions in the hospitality space is clear going forward.
Yep. Another big story that's sort of emerged throughout this whole crisis, or at least in the early stages of it, is is what I'd like to say sort of a tale of two borrowers, or at least two types of borrowers, which is you have on one hand the groups who are using repo lines and other revolving credit facilities to leverage fairly liquid assets like CMBS, and that group got pretty badly burned by margin calls early on. Then on the other hand, you have sort of these bigger, more sophisticated groups that are investing in things that the banks aren't maybe quite so eager to take the keys on, portfolios, operating businesses and things like that. I'm wondering a couple things, and first is how long do you think these groups can continue to sort of sing kumbaya and stay in this very balance of banks not really imposing covenants, giving sort of covenant relief, and essentially taking this very wait and see approach? How long do you think that can last, and what do you think the fallout will be?
Look, I think there's many questions, Kyle, embedded here. Well, first of all, yes, there's obviously been some large CMBS holders that have been definitely hurt, but at the same time, given the significant amount of liquidity coming in from the central banks, it's led to a massive opportunity for credit funds that were able to take quick advantage of that. And that's just not in the CMBS space, but other securitized assets as well. I think from stakeholders and others, particularly us, we're going to be seeing banks, as I mentioned, banks have already retrenched. They'll continue to retrench. We have some banks that are significantly diversified, like JP Morgan, Bank of America, and others. And we have others that are even the larger banks like Wells Fargo that is not as diversified as the non-performing loans continue to skyrocket when we have second and third lockdowns, and regulators may need to step in. Not portraying a particular crisis. Banks are much more heavily capitalized than in the past crisis, but regulators stepping in, they're going to not be that easy to provide capital. So that whole thing about singing kumbaya, that's gone. But using bank leverage to then use and buy securities like CMBS, it's going to be more difficult to come by. I think the opportunity for a family office, for a credit fund, and even developers that have the liquidity will be to look to buy CMBS from relative borrowers. And then the loan-to-own situation comes in where they basically take over those properties. And if they have the development experience or have the relationships with developers, can then reposition those assets or rejig them to meet the current environment that we're operating in and get a decent return. So I think the opportunity is more in that sense in terms of finding opportunistic areas to exploit this economic situation, and buying securities at distressed prices could be one area. And as I mentioned at the start, some of the money from that $2 billion I mentioned to a large U.S. developer will be going to just that as part of the opportunistic distress portfolio.
Yeah. Also, how are you dealing with distress in your own portfolio? Have you been lenient with borrowers? And if so, can you kind of give us a sense of what some of those terms have been like to enable that?
Look, so at the end of the day, we really don't own and operate and manage the assets. We're financiers, so we're providing the capital to those people that are a lot smarter than us in terms of the operating and management side. We think we're very good on the structuring and banking side. So when we find developers that are having problems or they're having problems with their tenants, etc., then we try to work out as best as we could, like anybody else. We do not want to own and operate assets, as I mentioned. So we prefer to figure out ways to modify so that, again, we can take a longer term approach to this perspective, which is very helpful. We don't have LPs that we're beholden to.
Gotcha. That makes sense. Yeah. Something that is another concept that's out there is this idea of a wall or a wave of capital that's somehow about ready to crash down, which I guess is to say that there's a significant backlog. Pardon the siren on this end, if you can hear that. A significant backlog of money that needs to be put to work, and I'm wondering what your take is on that idea, and if you expect that there will be a meaningful impact on the market from that sort of a backlog or wave of capital.
Listen, as sitting at a family office, I see presentations from opportunistic credit funds and others all the time. Massive amounts of liquidity have been raised in recent years for them for just these type of economic crisis, although nobody was thinking it would have been the human toll from a pandemic would have triggered this. Nonetheless, there is a massive amount of liquidity floating around in markets, and it's prompted by that unprecedented timely response by the central banks globally and the war chests by these credit funds. So you might say there's a wall of lots of liquidity chasing fewer assets, but as I mentioned previously, this is an economic crisis not witnessed since the Great Depression, and there will be lots of opportunities to put that capital to work. In fact, that initial window that closed very fast in the first 3 months of lockdown from the pandemic, as I mentioned, we're going to be having a second lockdown here in the UK starting this week. It will likely extend across the globe once again. We might have a third lockdown as we hit the winter. So I think the economic impact on that is going to be quite significant, and there'll be a lot of opportunities for us to exploit. Personally, away from the family office, I'm going to be looking to do just that with personal and friends and family, trying to leverage our experience, our operating development experience to, put capital to work. But where the larger credit funds and private equity and family office are focused, I'd try to focus more on the small, mid-size mom and pop areas or smaller mid-sized developers that might not have the opportunity to the liquidity from the central banks, the large credit funds, et cetera. So there's definitely an opportunity in what I would say the kind of the 20 million to 100 million or 20 million to 50 million type of size. Those small and mid-sized companies are been decimated. And so I think there's an opportunity to step in and help in that way. And there's also a social impact there.
Right. Well, during our prep call, you mentioned having signed term sheets on about $5.5 billion of investments since that first lockdown. Do you want to, those, are you targeting similar investments, or maybe you want to run us through some of those investments and maybe tell us a bit about how you were able to progress them and how you are progressing them in this current environment?
Well, there's no more lunches now during the pandemic. There's no sitting time on the tube or train getting to work. So I kind of plant my butt down in my chair from 7 a.m. in the morning London time and working U.S. hours. Sometimes I was out to the West Coast. So 10 o'clock at night, I'm still sitting here until my little girls come in asking for gummy bears or screaming, yelling. Luckily, my wife's keeping them aside. But more serious. Over 5 billion engagements, term sheets, and others that I've signed since March. It's been helped by Zoom chats, etc. We're just planting myself here. It's mostly been global in nature, and it's mostly been residential. It's kind of UK, Western Europe, US, a bit of the UAE, bit of Latin America. There's, like I said, highly rated to residential. And residential, it's not homes. It's less focused on actually apartment buildings, or it's much more focused on what we call in the UK BTR, build to rent. So which is a very new concept here in the UK and Western Europe, but obviously something that's going on in the States for many, many years and highly successful. We think it's a lot easier to lend against those type of assets, particularly in parts of Western Europe and the UK where the supply-demand imbalance is so great that the rental market, there's a significant need for it. Outside of London, we look at Manchester, Birmingham, Nottingham, Liverpool, etc. The supply-demand dynamic is such that people now can't afford to put the deposits down for a home and get on the property ladder, but they can rent. So the rent, the build to rent model is interesting. The rent to own model, where people rent their house, they rent their flat, apartment for a little while, where a certain amount of money is taken each month and put into escrow for them, so they could actually have a deposit to buy. There's obviously a good social element to that. That's where we've been focusing a large part of that 5 billion. So this kind of build to rent, rent to own model. We are looking at some investments in hospitality. That tends to be in the high end or ultra high end operators, such as like a Six Senses, and Beach. The larger operators like the Mandarin Oriental. The focus more on the tourism sector, the big office. That's going to take a long time to come back, as people will need to be using Zoom. It's going to be very hard to get human resources to sign off on the bigger organizations to actually go meet somebody on the plane unless it's absolutely necessary. I think the big office venues, big conferences are kind of not anytime in the near future, definitely not probably over the next 6 to 12 months. So, but hospitality, tourism, just once the lockdown ended, people here in the UK, for instance, the first thing they do is they pay their car lease, right? And they pay their rent, and they go on vacation. And that's a similar trend in Western Europe, and nobody's going to change that. And we've seen that occur as soon as lockdown ended. It was almost near impossible. A lot of it was staycations in their respective countries. So my point is focusing on certain hospitality operators that have the wherewithal, the liquidity to get through this crisis, is where we would kind of focus. But as I mentioned, the majority of the monies that we put out has been to in the residential space. And again, it's more of the that multifamily, some mixed use rental type of market, rent to own, build to rent.
Right. So what's your assessment on market pricing then? Has there been much movement on that in recent months, or things been stagnant? And, do you have a sense when we might actually get back to some level of normalcy, or maybe what would have to happen in order for that to take place?
Listen, I don't have a crystal ball. Nobody does. But what I can tell you is what we're doing. And anecdotally, I sit on calls like this pretty much every day. I speak to a lot of my credit opportunities funds, private equity, sovereign wealth funds, other family offices, pension insurance colleagues that are invested highly in real estate, and many of which have been doing it for many, many years. I would say there's definitely been a widening in credit spreads on the senior side, as well as obviously on lower parts of the capital stack. So the credit spreads have widened, but because rates are so low, the absolute level of coupon, you might say, has not changed dramatically. I know from our portion at the Wimmer family office and our partner family office, over 5 billion, as I mentioned, in monies that we've signed term sheets and engagements on. Our senior debt rates haven't really changed much. We're kind of in the 5 to 9% range, depending on geographic location, asset type. Might even be lower, could be in the kind of 4 to 6% range. Hospitality is going to be at the higher end. Residential in the larger cities would be, or near there, is going to be at the tighter range of that range. As I mentioned, where we're really focusing more is where we put our equity money, and we're demanding IRRs that might have been in the high single digits, low teens, now to be up in the high teens, low 20s. Otherwise, there are other relative value opportunities away from real estate or other parts of real estate for us to focus on.
Right. Well, you touched on another sort of magic keyword, which is rates. Of course, we've been in a low rate environment globally for, quite some time. It was a focal point last year. And of course, even this year, it's gone lower. And now you had an environment that was lower for longer that now may be essentially lower forever. And I'm wondering how that is impacting your investment strategy. What's sort of the impact of having, that sort of very, very low rate and a very, very long anticipated window for it.
I mean, look, we can look at the long-term trends by the amount of massive fiscal stimulus that governments are doing in the U.S., Western Europe, and across the globe. The massive amounts of liquidity that's been injected in the situation, which is going to lead to inflationary expectations rising in the longer term. But right now, we're in a deflationary environment, and it's significantly deflationary. As I mentioned, we see a second, third lockdown. Every component of aggregate demand is going to continue to collapse. We might have seen a great uptick when the lockdown ended as we got into the latter part of the second quarter and the third quarter, and we'll see a rebound in growth, et cetera, from very low levels. But once those lockdowns occur again, and they're already occurring, those components of aggregate demand are all going to collapse. So I think the word is deflation, and we're in a deflationary environment. It'll be like that for the foreseeable future. Obviously that has its implications for industry, the health of economies globally, but on the real estate side and stuff, as I mentioned, will demand higher credit spreads for the credit risk that's being taken, but the overall yields will be maintained at a relatively lower rates, which will help in debt servicing, with also the help of some modifications, et cetera, just because of the current environment.
Mm-hmm. Right. I want to change gears a little bit here to another long-term discussion point, which is ESG, something that's been very topical the past couple of years. And I think, if nothing else, this year has sort of shown exactly what happens when you don't tend to those three things sufficiently, the environment, social issues, and governance. Sort of we're seeing that play out on a macro scale, at least in the US. And during our prep call, you described it as something that always needs to be part of an investor's toolkit. So I'm hoping you can maybe expand on that a little bit and talk about some of the disconnects that are maybe out there in terms of the perception of ESG and how it should factor into an investment strategy.
Look, last year at the PDI in New York, my panel at the time was entirely focused on ESG. Look, ESG is something that's ingrained in us as credit analysts from Credit Analysis 101. It's become a sexy topic in recent years. Everybody's got to be ESG compliant. There's ESG ratings, mutual funds focused on ESG. Listen, environmental liabilities, social responsible investing, and corporate governance has to be the toolkit of any corporate credit portfolio manager, lender, analyst, going back in time. If you don't watch the environmental liabilities, they could have a significant impact on the credit quality of the borrower that you're lending to. Social responsible investing, I mean, just go back to the years of the tobacco bonds, etc. You're not going to invest in coal mines if the rest of the world doesn't think it's the right thing to do. Obviously there'll be a spread that'll attract people to it, but social responsible investing. Corporate governance, you have the best company in the world that has bad corporate governance, that company's going bust. So it's just a part of the analysis that should be part of everybody's toolkit. Now, listen, I'm in my mid-50s, okay? When the millennial generation gets to be my age, then we won't be talking about ESG anymore. ESG will just be a part of the proper investing toolkit of everybody. As I said, it is and should be part of going forward. It won't have to be discussed in the future.
Right. That makes sense. Yeah. Well, I mean, as an investor, it's obviously your primary objective to put your money behind things that are going to be profitable. But as a family office or coming from that world, you might not be under the same sort of constraints as maybe a public pension or a life insurance company on the return side necessarily. So I'm wondering if this puts you in a position to have sort of a wider berth as an impact investor, or helps you approach those types of investments maybe in a different way than some of those other institutions.
Look, my colleague and founder of our family office, Per Wimmer, wrote a book called The Green Bubble. It's been translated in many different languages. Impact investing, must be profitable. Otherwise, it's charity, and that belongs in a separate pocket of money, and it's not what we're paid for as being money managers. That being said, impact investing is quite important, and as a family office, it's part of our ethos. But again, we have to look at impact investing on whether it's going to generate a proper return. We're not in the business of providing charity, and companies that don't provide an adequate return for the capital that's being deployed will fail. So obviously we need to take that all into consideration. And it fits within the ESG proper credit toolshed.
Absolutely, absolutely. Another part of ESG that's sort of come into focus this year, is diversity. Of course, I think there's a greater awareness of sort of disparities, racial and otherwise, throughout society. And I'm just curious what sort of role diversity plays in your decisions to partner with a group or lend money, or just sort of generally do business with another organization. And I'm wondering if you have any sort of changes in that policy moving forward because of recent events, or just what your thoughts are broadly.
Look, we at Wimmer are very mindful of this important, sensitive issue. Look, I'm seeing Western Europe as a firm, although we're small, I would say it's a bit of a mini UN in terms of countries represented, race, religion represented, etc. So, diversity is core to my family office. I think the pandemic and separately kind of the social and racial problems going on in cities across the U.S. is really a human tragedy. It really needs to be addressed. Hopefully the pandemic has given us leaders, particularly at the PDI conference, a better sense of social responsibility, empathy, and the need for diversity and inclusiveness. I'm the vice chairman of several committees at the GRI Club. Last month, we hosted a discussion among many of our C-level executives on this topic of diversity and inclusiveness. And we had the author Ruth King as our guest speaker. I'd encourage everybody listening in to read her book. It's called Mindful of Race. It's truly eye-opening, and I think it'd be very helpful in terms of bridging the gap and the divide that's going on. As I mentioned when you asked me, Kyle, about what we're doing at our family office, and myself, personally through my separate advisory business, as I mentioned, I'm looking forward to raising some capital amongst myself and friends and family and others to see if we could help in the terms of the small and mid-size developers in raising capital and providing capital for their projects, etc. And I think diversity and inclusiveness in terms of our organization, as well as the developers that we're looking to provide capital to, will represent those virtues as well.
Absolutely. Great. Well, we are sort of coming up towards that 5-minute mark, so I do want to open up the floor to questions from the audience if we have any. We've certainly covered quite a bit, but I want to make sure that anyone who's got a burning question has a chance to raise it. Let's see. Not seen any just yet. So I will, I'd like to maybe circle back on the topic of office investment, something we touched on briefly, but do you think that that's an area that's likely to change substantially given all of the adoption of work from home and some of the other trends that have emerged during this period? Or do you think that, once we feel okay, we're gonna, go back to sort of business as usual on a wide scale?
Look, nothing's happening anytime soon. As I mentioned, we're going back into lockdown here in Europe, and it'll likely happen in the States relatively soon. Again, the office environment and dynamic has clearly changed. I'm not saying anything anybody else doesn't already know. Obviously, from our capital, from a family office perspective, I think we're going to take a much harder look at our investments if it goes into office. I think there's great Class A office buildings in cities, away from the large metropolitan cities that have been relatively unaffected. There's large tenants there, and they're continuing to pay their rent. Occupancy is high. Landlords are working with them to modify their rent if needed. As I mentioned, that can't go on forever. Banks will foreclose if it doesn't, if it continues. However, I think, in the terms of the larger cities, we're resilient. Look at New York in particular, in the various crises and stuff. People need to socialize with other people. It's just part of our innate attributes. People will come back to New York. I think New York will be resilient. People will want to work in large office buildings. Those office buildings, as I mentioned about our hospitality investments and hotel in particular, will have benefits of different types of technology to monitor individuals' health in terms of sickness, fevers, other stuff. And I think that'll become more prevalent going forward. So I think there's a lot of opportunity to invest in those companies that are providing the technology for that type of real estate going forward. Something that we're looking at.
Right. That's sort of the prop tech space is always interesting to me. And I'm curious if you have that in a bucket of just tech investment, or, is that also in real estate? Like, how do you sort of classify it on your own as part of your own portfolio, and what's your approach there?
As I mentioned, we're pretty much stick to our knitting type of family office. So we're focused on alternative energy, metals and mining, natural resources, real estate. Technology is less important. So it would be something that would be funded as part of kind of a smaller pocket of capital. Although I would say we're doing some rather large stuff in the satellite space, but that's also because of Per Wimmer's experience in that area as a founding astronaut of Virgin Galactic with his dear friend Richard Branson. So, technology is probably something more of a side pocket and part of our Wimmer family office rather than our partner family office.
Sure, absolutely. Sticking with the tech side of things, another trend that I've noticed and has been talked about is sort of investment in tech supportive real estate. So I'm thinking data centers and things of that sort. Potentially cell towers, although that's kind of more on the infrastructure side. Is that an area of interest to you, to your group at all? Those sort of alternative types of real estate?
Listen, I think everybody's been talking about logistics, data, investing. If we look at the pandemic since lockdown, those assets have not seen any significant price correction. If anything, pricing has held up quite well and has even gone up as people have focused their attention on that, as well as also some healthcare opportunities. So the real question, I think, there is, is there opportunities in data-centric logistics, et cetera, and technology surrounding? Absolutely. And I think it'll continue to attract more capital, but it's becoming somewhat of a crowded space.
Absolutely. We're coming up on our last minute here, so I think maybe it would be a good opportunity to sort of provide some closing thoughts. You've talked about sort of the risks coming up and sort of the broad-based disruption that's not only taken shape but is sort of going to come around for a second wave soon. What are some things you're hopeful about in the real estate space? Maybe you can kind of close that on a positive note.
Look, I think we've touched, Kyle, on a significant amount of things from pricing to economic costs to underwriting standards, et cetera. If I'd like to leave any message, it's kind of what we're talking about in the diversity and inclusion. Look, this pandemic has created social problems much greater than just the economic and financial costs. And I think it's important as leaders at a conference like this at PDI, where you're represented from some of the most important leaders across the asset management spectrum, to really look at this pandemic as a way to get a better sense of social responsibility, more empathy, the need for diversity and inclusiveness in their capital allocation decisions. And, hopefully we will all be better for it.
Well said. Well said. I think that summarizes it nicely. Well, thank you, Peter, for taking the time to have this conversation. I found it very insightful, and I hope everyone else did as well. And thank you all for taking the time to join us this afternoon. And hopefully you enjoy the rest of this week's events.
Thanks, Kyle. And I also put in the chat my email if anybody would like to discuss family office or some of the issues that we've discussed today.
Great. That's perfect. Hopefully